We're glad you could join us at this new time for the latest installment of the Options Industry Council's webinar series. My name is Alexander Osinga, and I'm a staff member here at the OIC. I'll be guiding you through today's webinar, Putting Your Best Foot Forward with Options Fundamentals. I'm pleased to welcome our presenters today, Joe Burgoyne and Mark Benzequin, who are integral instructors for OIC, providing investors with the core teaching essential for options investing. Joe Burgoyne is the Director of Retail Education for the Options Industry Council and is responsible for the institutional, retail, and university outreach educational programs. He has over 30 years of experience within the finance industry and has managed the floor operations at the Philadelphia Stock Exchange for Von der Molen Options USA and TAG Securities. Mark Benzequin is a Senior Investor Services Specialist for the OCC. He is responsible for providing support to a comprehensive options resource center that provides information and education about options and supports all products traded on all OCC participant exchanges. Mark began his career in options with Stafford Trading before transitioning to brokerage operations. But Mark spent most of his career in the trading pit, gaining special insight into custom order flow and trade execution. And now, ladies and gentlemen, Joe Burgoyne will bring you our topic today, Putting Your Best Foot Forward with Option Fundamentals. Joe?
Alex, thanks so much, and welcome everybody. As Alex said, we're trying a new time, and we're going to do that over the next 3 months. You know, we're middle of the day here as opposed to after the market close. So maybe in the survey section, if you can offer your feedback on what you think about the new time, we'd greatly appreciate it. We're trying to meet your needs, and a lot of the feedback we got in the last year suggested maybe a time like this might be better for more folks. But it's great to be with you and to join Mark and Alex in our first webinar for the year. I think many of you may know about the OIC. We've been the educational arm of the options industry since 1992, and it's the OCC who now funds us 100%. In the past, it's been a combination of the exchanges and the OCC, but now the OCC has taken the mantle to fund the OIC entirely. And for those of you who don't know, the OCC, in addition to being a thought leader in the industry, is the world's largest equity derivatives clearing organization, the Foundation for Secure Markets. It frankly is the OCC that is one of the things, and I think one of the key elements that sets the listed options industry apart, because it's the OCC that handles each transaction and takes all responsibility for counterparty risk. Also, before we get started in today's actual content about fundamentals and base building options knowledge, it's important to understand for those of you, especially who are just getting started in options, that you realize that options involve risk and are not suited for all investors. And the point and really the privilege of all of us here at the OIC is to be able to help you to build a base of knowledge so you understand the risks and benefits to the listed exchange product. These are the 5 parent exchanges. We have a total of 15 exchanges, but many of the exchanges have a number of different exchanges. There's the Chicago Exchange, the NASDAQ, BOX, MIAX, and New York. They are the 5 parent exchanges that make up the industry now. For those of you who have joined us in the past and heard me, this is one of my very favorite slides. It's a snapshot of the growth of an industry that didn't exist in 1973 in Chicago when there was one exchange. We had 16 companies listed. They're now over 4,400, combination of individual companies, ETFs, and indexes. Many of you may not realize the first 4 years in the industry, we only had calls. The SEC didn't even approve puts till 1977. So we started from nothing, and more recently, despite incredibly low volatility, as many of you probably realize, the industry has continued to sustain volume that exceeds 4 billion contracts a year. Last year, we did just under 17 million contracts a day. So we've got a lot to talk about. Mark Benzequin, you want to jump in and talk about the outline and maybe a couple questions?
Yeah, Joe, I'd be happy to. Thank you. And, welcome to everybody to joining us today. Very, very happy to be here. And what we're going to be talking about today is, as Joe and Alex had mentioned, we're going to be looking at options basics. First and foremost, in order to understand something, we need to know what it is. So Joe's going to talk about the definition of options as well as the different types that are available. I will then go ahead and go into some of the more technical aspects in terms of contract trading and the concepts of exercise and assignment. Joe and I will then each discuss option pricing and the concept of premium before we get into some of the more basic option strategies like buying calls and buying puts. Now, before we get into it, we kind of want to get a little bit interactive with our audience, engage the options experience that our listeners have. So let's start off with a polling question. First and foremost, have you ever traded an option? Simple question, yes or no. Do you have any experience trading options? And it looks like we're pretty evenly split here. Joe, you do? I'm glad to hear that.
I do.
Looks like
so do you.
True. We've both been in the business for a very, very long time, as our wrinkles certainly reflect. And it looks like the audience as well. Fairly evenly split here at about a little over half have traded options in the past, while just a little bit under haven't, which is great because, what we're going to be talking about today, again, it's the options basics, it's the options fundamentals. So it's the, you new attendees or you beginner attendees, those are the people that we want to directly speak to today, as well as some of the more seasoned listeners that hopefully they'll gain something that they may not have known or looking at it from a different aspect. So that being said, let's go to another question here, your experience with option. Obviously, for those of you that haven't traded options before, I would certainly expect your experience level to be beginner. Those of you that have traded options, you may consider yourself beginners as well, or advanced traders. So let's take a look at how you would describe your experience with options. And we'll give you just a minute as these numbers begin coming back. And it
One
looks
other
like
thing,
the
Mark.
majority. Yes, Joe.
I was just going to say, attendees, feel free to, send in questions as we go through the presentation as well.
Yeah, good point, Joe. Excellent. We will be addressing some of those questions during the presentation, as well as those that we don't get to. I know Alex had mentioned the Investor Services Desk will definitely be responding to those during the week. So it looks like with our attendees, the overwhelming majority are beginner, which is terrific. And like I said, when first learning about something, it's best to define what it is. So, Joe, if you don't mind, why don't you take the helm here and talk about the definition of options?
Absolutely, Mark. And I love the mix, a solid almost 50-50 split there in terms of folks who have and have not used options. Really, the mission of OIC, and I think the industry had a lot of foresight in creating the OIC. Our mission really is to build that foundation of knowledge. So let's start. As Mark said, obviously we got to define what an option is. And options, I think there's a real misconception in the marketplace that the option product is very complicated. And the fact of the matter is, it's not unless you make it that way. So, we'll go through defining concepts today. Really, in the next 30 to 45 minutes, you should have a darn good foundation. The one thing I think that can be a little bit of a challenge out of the box is some of the language and lingo. But, hopefully we'll get through that. So options are contracts. Straightforward. We all know what a contract is. Buyers purchase rights. And the rights that they purchase when they, buy an option are the right to either buy or sell the underlying asset. And that underlying asset is either an individual stock, index, or ETF. So buyers purchase rights. Sellers take on obligations. And the obligation to selling that option, depending on whether it's a call or put, is the obligation to either buy or sell that underlying. And we'll go through exactly, what a call and put represent. So options are contracts that give buyers rights, sellers take on obligations, And this is where we get into the detail. At a specified price on or before a given date in the future. That's what the contract represents. The buyers, as I said more than a few times, have rights, sellers have obligations. But Mark and I will repeat some of these things today, some of these concepts, because it's the foundation. And, you know, once you have a foundation, you build confidence, and hopefully you put your toe in the water if you decide that the option product is for you. So, you know, why consider options? Well, you know, maybe you do fundamental analysis, technical analysis. Options give you a chance to, you know, get into the marketplace. Options also, you know, to me, they're two main issues. You know, it's risk reduction, it's portfolio protection, that's number one, and then potentially income generation too. They're the two main reasons for options. You know, stock acquisition, that can, you know, certainly be part of it, depending on, you know, the strategy you're involved with. But the vast majority of investors use options for two reasons: income generation and, you know, risk management. Speculation is in there too, but that's really an outlier. One of the keys, and these slides, by the way, were created by my co-presenter, Mark Benziquan. He offered, that's a picture, that's you there, isn't it, Mark, in that slide?
Certainly not. Not anymore.
Offering flexibility. There is lots of flexibility with options. If we look at the world, the investment world, without options in terms of stock, you know, basically you're long stock, you're short stock. Most retail investors don't play, you know, the stock game from the short stock side. Most, you know, certainly are just long stock. Make money if it goes up, lose money if it goes down. The opposite is true if you talk about shorting stock, which again is not for most retail investors. So really no flexibility. You're up or down and that's it. Options offer enormous flexibility. I think the balance, especially for you investors who are rather new to the option space, I've got 18 different strategies on this slide. And the reason they're all there is just to emphasize this idea of flexibility. What I'd like to emphasize is you don't, you know, need to get to know all of these different strategies. You need to, in my opinion, build the foundation of knowledge and then, you know, decide on, well, once you've decided, if you decide that the listed options product is for you because of the various benefits outweighing the risks, decide on a couple bullish, bearish, and neutral strategies around your favorite underlyings. And, you know, these different 18 strategies are some of the choices that you have. It's not important to understand them all for sure. Let's talk about, you know, calls and puts just to hit home some of these core concepts. When we talk about options, I mentioned, you know, the lingo in the industry. We've got two types of options. We've got calls, we've got puts. And for equity or ETF options, the underlying asset is what is purchased or sold. It's either the underlying stock itself or the ETF, unless we're talking about index options. Each option corresponds to 100 shares of that underlying or ETF. Going back to this concept of rights and obligations, okay, options are contracts that give the long call purchaser the right to buy 100 shares of that underlying at the strike price, and we'll go over strike price a little later on, at any time before expiration. That's the right that the call buyer, you know, acquires. If you buy a put, you get the right to sell the underlying. And so we've got four different choices here. We've got call buyers and put buyers, and then we have call sellers and put sellers. The call seller takes on the obligation to sell or deliver the stock, index, or ETF, where the put seller takes on the obligation to buy the stock. We reference different strategies for stock accumulation. This idea of selling puts is a strategy that does allow you to acquire stock at a particular price. So right here, this slide number 13 is one that if you're new to the option space, really, you want to be crystal clear on the rights of the call and put buyer and the obligations of the call and put seller. Equity call options. Again, the call buyer has the right to buy the underlying stock. When we talk lingo, if you're long the call, the lingo is, if you buy the call rather, the lingo is, I'm long the call or I'm the holder of the call. Equity call sellers take on that obligation to sell the underlying, and the lingo is, I'm short or the writer of those options. On the equity put side, the equity put buyer has the right, again, to sell the underlying stock. Same as with the call, the lingo is, I'm long the put or the holder of the put. And then that equity put seller has the obligation to buy the underlying stock. So those four rights and obligations, please do your best to, get them straight. I think we'll start talking about option contracts. And Mark, can I turn it over to you for contract terms?
Yeah, absolutely, Joe. And let's continue a little bit with that options lingo that you were giving us here. When it comes to an option contract, contracts in itself, an option is a contract like everything else. We've got an expiration date. We've got standardized terms in which we know the underlying stock. We know the unit of trade. We know the strike or the exercise price. Again, like Joe had mentioned, we'll get into that in just a little bit. And we know how long that contract is going to be good for. So the terms of the contract are known up front between buyer and seller. Now let's go ahead and break down what those terms are. When we look at an option trade, an example that we have here, XYZ December 45 call at 2.5, that's an example of what you might see for an option trade. Now, what does it all mean? We talked about those standardized terms. First and foremost, the term of the underlying. We've talked about how it represents 100 shares of the stock, typically on which the right or the obligation exists, meaning you're buying 100 shares of stock, or you have the right to sell 100 shares of stock, or you have the obligation to deliver 100 shares. In our example here, the XYZ December 45 call, XYZ or Tesla or IBM or the SPX or Spiders, what have you, that is going to be the underlying. Now, the expiration date is the date on which that option ceases to exist. In our example here, we're talking December options. Now, there's different options. We've got monthly contracts that typically expire on the third Friday of the month. We've got weekly contracts that typically expire on any given Friday of the month, and some contracts even now have Monday and Wednesday expirations as well. So if the date is not listed, meaning if we don't have December 21st, for example, if the date is not listed, that tells us it's a standard monthly contract with expiration on that third Friday. Typically nowadays, with all the different expiries, the date will be listed, and that will tell you that listed date is the date upon which that option ceases to exist. The next thing that we're talking about is the strike or exercise price, which we referred to several times already, and that's the price at which we are agreeing to buy or sell that underlying. So in this particular case, XYZ December 45 calls, we're willing to buy those shares or sell those shares, or we're accepting the obligation to buy or sell those shares for $45. Lastly is our premium, and that's the price upon which the option costs, meaning that when we buy an option contract, we're buying the right to purchase or sell shares. We need to pay for that right, and that payment is in the term of premium. Option sellers, they have the obligation to buy or sell those shares, and for that obligation, they collect that premium. Now, Alex and Joe were mentioning earlier about the survey, and one of the reasons the survey is so important is that we get ideas from the audience and from the attendees, not only on what topics they'd like to see in the future, but other comments about the presentation. One comment that we often get is if we can describe what happens with an option trade. You know, you place an option trade, what happens from the moment you click that button or that moment that you contact the broker. So we've come up with a brief presentation here. the life cycle of an option trade. And typically it starts out that the investor places your order. You place your order either at the computer on your trading platform, or you give your broker a call. That order then gets routed to one of the option exchanges. There's a term that we have called NBBO, which is National Best Bid, Best Offer. And what it really means, if you're looking to buy an option contract, your broker will typically route that order to the best selling price in the market. If you're looking to sell an option contract, your broker will typically route that order to the best buyers of the contract. Once that happens, the order is presented to the marketplace. It can be presented either electronically or physically in the trading pit. I was a broker for 20 years on the CBOE Options Exchange, so I typically got my orders coming in over the telephone. We present those orders then to the crowd, and that's where the negotiation begins. When you're looking to, for example, buy an option contract, if you want to pay $1 for it, but the crowd is willing to sell the contract at $1.10, well, that's where negotiating comes in. Maybe they would sell it at $1.05. They'll tell you that they'll sell that order at $1.05, or they'll say, you know what, we'll take your dollar order and you're filled. That option contract then gets executed. Once it gets executed and that order is filled, then what happens is the information gets relayed to the exchange, which then relays that information to the OCC, the Options Clearing Corporation, that acts as the counterparty to your option trade. Let's say Joe and I engage in an options trade. I buy a call, Joe sells it to me. Well, then what happens is Joe and I, our relationship, once that trade clears, our relationship is over. I don't care what Joe does with his position. I've got my call that I bought, and the OCC acts as the counterparty. After that, the information gets relayed back to your broker and therefore back to the investor. You have your trade and you'll see it in your account the very next day. Now, another question that we get is often about exercise and assignment. And this is the process. We've got an option contract where we have the right to buy or sell shares at X amount of dollars. Well, how does that come about? And the way that that comes about is exercise and assignment. Again, we've discussed option buyers have rights to buy or sell 100 shares of stock at that strike price, and that happens when you exercise that contract. When you're telling your broker, all right, I just entered into this contract to buy 100 shares of stock at a certain price, I want to go ahead and call that contract due. And the process by which that happens is called exercise. Now, to do so, you will either notify your broker of your intent to exercise, or if the option contract is what we call in the money, and that's a term that Joe will describe a little bit later, if that option is considered in the money by a penny or more, then often it is subject to what we call auto-ex or auto-exercise. That option will automatically be exercised. Buyers only can exercise the contract. Buyers have the right to exercise that contract, while sellers have the obligation to accept assignment. So as an option seller, you're agreeing to sell or buy 100 shares of stock at the strike price, etc. When you get assigned an exercise notice, you will receive that notice from your brokerage firm, and again, only sellers can be assigned on that option contract. Another question that we get is, how exactly does this exercise and assignment process work? So what we've done here is we've got our investor, and the investor will either notify his or her brokerage firm that they wish to exercise the contract, or if that contract is in the money by a penny or more, it will automatically be exercised. That brokerage firm will then notify a clearing member firm, which basically you can think of as your broker's broker. The clearing member firm then notifies the OCC that they have a buyer with a long options position that wishes to exercise the contract. The OCC will then randomly use an SEC-approved random assignment process, and that process will randomly assign a clearing member firm, who then will randomly assign a brokerage firm, who then will randomly assign an investor that has a short position opposite the long position that was just exercised. Now, when it comes to exercise, there's a couple different styles. First, we have American exercise, and an American exercise option, that's where we have our equities and ETFs, our stocks. When it comes to American exercise, one of the aspects of it is that you can exercise that option at any time. Any day of the week, any trading day of the week, you can exercise that contract. Conversely, that means that if you're a seller of the option, that means that at any day of the week, you can be assigned on that option contract. The flip side of that is European exercise, and I assure you that neither of these have anything to do with geography. So if there's a European trading firm or a European public company that is traded in the U.S., it's irrelevant geographically where they're located. It's simply the exercise style. European options typically are the index options, cash-settled indexes, and that is where exercise and assignment can only occur at expiration. Now, whether that expiration is a weekly expiration on a given Friday or if it's a monthly expiration on the third Friday of the month is irrelevant. What is relevant is those options can only be exercised and therefore only be assigned at that expiration date. Briefly, we talked about ETFs and equities and indexes, and that relates to the settlement style. We've got physical delivery where securities are credited to and cash debited from your account. That's where we have our stocks and ETFs, where upon exercise or assignment, it results in the physical delivery of shares. The flip side to that would be our cash settlement, which again would be the indexes, and that is where the option settles in cash. It's going to be the difference between the in-the-money value, and again, Joe's going to cover that in just a moment, and the settlement value of the index. That's what we call intrinsic value, the difference between the settlement price and your stock price. That's called the intrinsic value, and Joe's going to get to that right now. Joe?
I will, Mark. Thanks for the heads up. And, Mark's covering, an awful lot here. And, we're hitting hard on this whole idea of rights and obligations for the call and the put. Some of what Mark was describing was the mechanics of the industry and how things work behind the scenes. And we think that's important, to elaborate on, because you need to have confidence in this marketplace. And, we know how bad 2008 and 9 were, in the financial markets. And the listed option space, stayed open the entire time. Markets continued to trade. And it was because of the backing of OCC and the capacity to, match every buyer and seller that, really makes us such a secure marketplace. So I just want you to understand why, we're kind of getting in the weeds with some of what goes on behind the scenes. We think it's important. This whole idea now of pricing, getting back to, the contracts themselves. Again, a lot of these concepts are pretty straightforward. Language takes a little getting used to. So Mark mentioned this whole idea of intrinsic value. We talk about, and we'll be specific to calls here, in the money, at the money, and out of the money calls. It's important, really important, to get straight the difference between the price of the underlying. And in our example, you can see highlighted in yellow, the stock price is $50. So in the example, it's a stock price. It could be an index, could be an ETF. But the important thing is the price, $50. Around that price, we have option strike prices, which we referred to earlier. So in our example, we've got different months as well, Jan, Feb, Aprils. We've got 40 calls, 45 calls, 50 calls, 55, and 60 calls. Now remember, when we went back to the early slides about rights and obligations, the call buyer has the right to buy the underlying at the strike price. So if you're buying the 40 strike with the stock at 50, that would be an option that has an awful lot of value because we're able to buy that stock at $40. And it's trading in the marketplace for $50 plus. So there's $10 of that intrinsic value, that in the money amount In addition to that, depending on the time frame, and we have options that, as Mark said, can expire in a week. Heck, we've got options that can go out over 3 years. So the more time you have, the more value you have in that option. So we've got the in-the-money calls as one type of call. And in our example here with the stock 50, the in-the-money calls are the 40 as well as the 45. Obviously, buying the Jan 45 call is the right to buy stock at 45. Well, if the stock's trading at 50, you've got $5 of intrinsic value, plus whatever time value there may be. Clearly, there's going to be more time value in the Februaries and Aprils than there will be in the Januaries. So those are the two examples of the in-the-money, the Jan 40s and 45s with the stock trading at 50. Clearly, with the stock trading at 50, the at-the-money strike is going to be the 50. So that 50 call, whatever month you pick, is going to be the at-the-money strike, the 50 strike. And then we've got these 55 and 60s, so they would be now the out-of-the-money calls is the lingo. What do those 55 and 60 calls represent? Well, the 55 call represents, the right to buy stock at 55. The 60 call represents the right to buy stock at 60. Well, you might ask, if the stock's at 50, why would you ever want to buy a 55 or 60 call? Well, one of the things that Mark and I haven't talked about yet, we've talked about some of the core concepts. You have rights, you have obligations. Each contract corresponds to buying or selling 100 shares of the underlying. Well, if you went out and bought 100 shares of an underlying at $50, you're going to tie up $5,000. You may go and buy a 50 call that trades for $1. It may cost you $100 for the right to buy 100 shares at $50. So there's the leverage in these products that is oftentimes really key. Each contract corresponds to 100 shares of the underlying. So, keep that in mind. Again, the in-the-money calls would be the 40 and 45 with the stock trading at 50. The at-the-money call would be the 50 calls, and the out-of-the-money calls would be the 55 and 60s. That's on the call side. On the put side, you have to flip that around. Why is that? Because the put is the right to sell the underlying, not the right to buy the underlying like you have with the call. So again, stock price 50, same strike prices ranging from 40 to 60, but here, as the slide suggests, these in-the-money puts are the 60 and the 55 because the 60 put represents the right to sell stock at 60. With the stock at 50, that right clearly is worth $10 plus whatever time value there may be. The 55, the right to sell stock at 55 would be worth $5 plus whatever time value in those options as well. So, that's where hard, not necessarily, confusing maybe, especially when you're getting started. Going back to those, that original, box where we had calls and puts, rights and obligations, you want to get them straight. On top of that, understanding that each contract represents 100 shares of the underlying at the all-important strike price. Again, don't be confused, by the price of the underlying versus the strike price. Two potentially very different things unless you're talking about an at-the-money strike. The 50s, of course, for the 50 stock on the put side would also be the at-the-monies. And then the out-of-the-monies would be the 45 and the 40, the right to sell stock at 45 with the stock at 50 is $5 below the price of the stock, so $5 out of the money, where the 40 put is $10 below, so $10 out of the money. Let's do a quick quiz before I turn it over to Mark for a little bit more conversation on intrinsic value. So this is where being clear on what's the stock price versus the strike price and the option itself. We've got the stock price of 55 and the 65 call, Is it in, at, or out of the money? that particular call. Hopefully you said out of the money by 10 bucks. We got the $77 stock with the 70 call in, at, or out of the money. Let's go through that. Stock 77, 70 calls. The right to buy stock at 70. If I can buy the stock at 70 and it's 77 in the marketplace, boom, that's in the money by 7 bucks. Hope you get that. Stock price 63. The 70 put. What does the 70 put represent? The right to sell stock at 70. If I can sell stock at 70, it's straight at 63. I've got $7 of value. So that's $7 in the money. 51 stock price, 45 put. What's that 45 put represent? The right to sell stock at 45. Stock's trading at 51. The right to sell stock at 45. That's out of the money by $6. Again, I hope that makes sense. Stock price $22.55. The $22.50 call, the right to buy stock at $22.50 with the stock a nickel higher, is in the money by a nickel. Back to one of Mark's earlier conversations about exercise and assignment. If you've got a stock price, let's say, the option price at $22.50, and that stock closes at expiration at $22.51, any option, call or put, a penny in the money or more, will automatically be exercised unless you tell the brokerage house not to for some reason. So that's a little bit about in, at, and out of the money calls and puts. Mark, all yours with Option Premium.
Well, thanks, Joe. As we described before, we were talking about how when you buy an option, it's going to cost you something. That right that you're purchasing is going to cost you, and that cost is what we refer to as premium. So the option buyer pays that premium. Now, we say it's non-refundable. Once you pay it, that money is gone. That's your investment in the option. However, that's not to say that you can't turn around and sell that option back to the market to close. As it stands, well over 70% of all option contracts do get closed out in the market, meaning that they don't live to see expiration. So often what happens is a buyer will buy an option to open and then later sell to close, hopefully locking in a profit. And that's typically what happens in the market. But regardless what happens, the option buyer pays the premium while the seller keeps that premium, whether or not they get assigned. So buyer pays, seller collects. And that premium is typically quoted on a 100-share basis. So when we talk about an options price of, say, $3, we're really talking about a $300 investment. And again, all of the figures and the examples that we're using today exclude commissions, trading fees, transaction fees, things like that. So definitely keep those in mind because they will affect the outcome of your trade. Now, Joe was mentioning intrinsic value and time value, so let's go ahead and break this down a little bit further. The intrinsic value is the in-the-money amount, as Joe had mentioned, whereas the time value is everything in excess of that intrinsic value. And one of the components of time value is time, and the closer we get to expiration, the less time there is. We're all familiar with the expression time is money, and it's never more true than when it comes to options trading. As Joe was talking about earlier, if you buy a January option versus a February versus a June, all things being equal, that June option is going to cost considerably more than that January. And the reason being, again, time is money. And at expiration, options are only worth their intrinsic value. That time value will decay as we near expiration until it gets to zero. And at expiration, the only thing left, if anything, is intrinsic value. There is no time remaining. So when you exercise that option contract, you are exercising it only for that intrinsic value. Now let's go ahead and look at a chart here that breaks it down a little bit more for us. Again, the option premium is made up of intrinsic value, and the intrinsic value is going to be that difference between your stock price and your strike price. The time value of your option is made up of a few different components. First and foremost, time. The more time there is, the more it's going to cost. Also, implied volatility. That's going to be a factor in that extrinsic or time value of the option. And then as well as interest rates and dividends, if any, associated with the option contract. Those are all going to be components of that extrinsic or time value. And when we add that to the intrinsic value, if any, of the option, that gives us our total premium. So again, in the money calls and puts, they do have intrinsic value. They may or may not have time value, whereas at the money or out of the money options have no intrinsic value. Their option premium is composed entirely of time value. And let's look at an example here. If we take our fabulous XYZ trading $53 a share, and the investor purchases the January 50 call for $5.20, we know that call is in the money by $3. Stock is trading 53. We have the right or obligation to purchase or sell those shares for $50, right? So that's giving us a $3 in the money amount, the difference between that stock price and the strike price. That's going to be the intrinsic value. Now, everything left over, that's time value. If the option costs $5.20, that's the premium quoted in the marketplace, and we know that the intrinsic value is $3, that leaves $2.20 of time value. And let's look at another example here. If we're trading a $60 call and the stock is still $53 a share and the option costs $2.10, what is the intrinsic value? What is that option worth, the difference between the stock price and the strike price? Well, if the stock is trading 53, that $60 call we know is going to be out of the money and therefore have no intrinsic value. If it has no intrinsic value, that means that everything left is time value. So $2.10, the price of the option, that is entirely going to be time value. And let's look at another quiz here to see how we've learned this. If we have a stock price of 77 and we have a $10 call, the option price is $10.50. Is that option in, at, or out of the money? What is the intrinsic value? And what is the time value? Well, we know it's in the money because it's a $70 call on a $77 stock. We have the right to buy those shares, assuming we're buying this option. We have the right to buy those shares for $70 when it's trading 77. So that's got $7 of intrinsic value that is in the money, and that tells us that everything left, that $3.50, is time value. Next, we've got a 60 put on a $58.50 stock. Assuming we're buying the put, that gives us the right to sell shares at $60 when it's trading 58.5. That tells us that put is in the money as well by $1.50. Anything beyond that $1.50 in terms of the option premium is going to be time value. So in this case, it would be $2.25. $85 call on an $83 stock. That's going to be out of the money. We've got the right to buy shares for $85 when they're trading 83. That's not a trade that we're going to want to be making too often, and it's costing us $2.25 to do so. Now, that's not to say that buying out of the money options or trading out of the money options is a losing proposition. Not the case at all. That's just saying that at that particular time, we wouldn't want to buy stock for 85 when it's trading 83. But by buying that option, we may be thinking that the stock is going to 90, and it's only costing us $2.25 of time value in order to reserve that right. So again, I just want to let people know that buying out of the money options doesn't necessarily need to be a losing proposition. And then lastly, we're looking at a $12.50 share price on a $12.50 call. It's costing us $1.50 to do so. The stock price and the strike price equal each other, so that is going to be at the money. Again, no intrinsic value, and the $1.50 premium is entirely time value. Now, we just talked about buying out of the money calls. Joe, why don't you take us through buying calls, if you don't mind, and tell us what that's all about.
Buying calls. Okay, we talked about options or contracts. You buy call, you have the right to buy the underlying. You're buying the underlying because, you're bullish on it, you think it's going up. That's basically the motivation. I mentioned briefly, this whole idea of a far smaller cash outlay than having to buy the stock itself. That's hugely important, okay? And then if we're buying a call, and we'll go through an example or two, there's a minimal cash outlay, and so therefore there's a heck of a lot less risk because we haven't put out that much cash. And that's, taking into account, maybe the prospect of that option going to zero. Basically, we're buying calls. Investors maybe want an alternative to buying the stock with leverage. And there you go. So don't forget, when we buy calls or puts, and Mark mentioned this, the buyers pay for the rights. Well, what those rights do, whether you're buying a call or a put, they give you control. Okay, you have obviously the right to buy at the strike price. If you're buying a call, you can exercise that option at any time. You can sell that option at any time. You have control of the trade. Or when you sell an option, and Mark will get into this, you're taking on obligations, but you're not sure when you may get assigned in different variables. So, as far as buying, the buyer pays the premium for the right, to basically have that control. Risk versus, in a long call versus the long stock. This gives you an idea. In one of the early slides, we showed that line. Basically, in a world without options, you make money to the upside, you lose a lot of money to the downside. When you talk about buying a call, you have that predefined risk of whatever the premium you paid for that call was, that's the most you can lose. And that's if you buy the call, take it to expiration, it's out of the money at expiration, meaning it has no value, so you'd lose all your premium in that example, but that going in. You have your, far less, smaller risk in terms of premium outlay. And that's just a big part of the whole idea of options. When we talk about, buying a call, you do have potentially unlimited profit potential, and the idea behind that is stocks can go to infinity. Certainly not the stocks that I own, but, everybody else's stocks can theoretically go to infinity. So, we talk in terms of upside profit potential being literally unlimited, and your risk is, the premium you put out there. Examples, I think, are always good teachers. Let's take a look at XYZ trading at $60. Our particular investor is bullish on the underlying, wants limited downside risk. So we decide to buy a 90-day or 3-month 60-strike call for $3. Okay, so the stock's trading 60. We buy a 60 call. Hopefully you realize that's the at the money. So there's no intrinsic value. There's no in-the-money amount. We're buying an in-the-money call. We're paying $3. Now, the way the premiums work, if we pay $3, each contract, as we've said, corresponds to 100 shares of the underlying. So you take that $3, multiply it by the 100 shares. Our cash outlay is going to be $300, plus commissions. Instead of buying 100 shares for $60 and putting out $6,000. Okay, so risk reward, the leverage associated with options. Here's how we look, at different stock prices at expiration. That left-hand column, defines the stock price at expiration. We bought the calls for $3 with the stock at 60 with 90 days to go. At expiration, with the stock at 60, let's start at the bottom and work our way up. At 55 or 60, the right to buy stock at 60, that right has no value. So at expiration, we'd have lost the $300 plus commission. Next number up is 63. That, is our break-even point. And the way you figure your break-even, again, really quite simple. It's just a question of knowing what numbers to add. You take the strike price, which was 60, plus the premium we paid, the $3. 60 plus the 3 gets us to 63. We needed that stock at expiration to be at 63 or higher to break even. 65, what's the value of that 60 call going to be at expiration with a stock 65? Hopefully you think it's $5, which is the correct answer. We paid 3, it's worth 5. we're up $200 minus commissions. And then if the stock had a really big run, in 90 days from 60 to 70, the value of that call would be $10. So, we'd make upwards of $700 on that particular trade. The dotted line represents, the world of stock indexes or ETFs without options, make money to the upside, lose it to the downside. In terms of that solid blue line, that represents, the option, risk-reward scenario. Unlimited profit potential to the upside, defined risk in this particular example, risk of $300. So, Mark, you want to go through puts before we take some questions?
Yeah, Joe, absolutely. So buying puts, why would we buy puts? Joe was mentioning with buying calls that you're bullish on a particular stock. When we buy puts, we may be bearish on a particular stock, or we may be looking to cover or protect an existing stock position. So we buy puts, we're looking to benefit, again, as Joe had mentioned with calls, with a small cash outlay, limited predefined risk. Anytime that we buy options, that limited predefined risk is 100% of your investment. Rather than paying $6,000 for that stock like Joe was talking about, you can invest $300 by buying that call in the example that Joe had. That's going to be the maximum amount of risk. Anytime you buy an option, the most you can lose is what you put into it. Another reason to buy puts is we want an alternative to selling stock short. If we sell stock short, we have literally unlimited risk. That stock, as Joe had mentioned, can go to infinity. Like Joe, that's never happened to me. It usually goes the other way. However, again, with buying options, you pay that premium, you pay that upfront, and in the case of puts, it gives you the right to sell shares at that strike price during a specific period of time. We can see here graphically the difference of buying puts, the difference of risk versus reward. Just one quick thing that I want to interject here, and it may be a little bit more advanced for our beginner audience. When it comes to options, the easiest way to visualize your risk and visualize your reward is to graph out your chart. And that's what we have here. We've got our profit and loss, and then that's on the vertical axis. The horizontal axis, that is going to be your stock price. So as share prices drop, you can see here with the puts, that's where you make your money. As share prices increase, you're going to lose up until that maximum risk, which is the amount of your investment. So risk is limited to the premium paid, while your profit potential is substantial. Theoretically, the stock can go down to zero, which is what happens to me usually when I invest. So, puts are definitely a good thing if you invest like me. Here's a quick example. Stock's trading 36. We're bearish on the stock, and we want to limit our upside risk. So we're going to buy a 35 strike put for 2.25, or the equivalent of $225. Now, as you can see, if the stock goes to 40, the value of that put is going to be zero, meaning if we have the right to sell stock at 35 and it's trading $40, well, that's not going to have any value whatsoever. We're going to lose the total investment, our $225. We're going to lose at 40, we're going to lose at 35. Our break-even point is going to be $32.75. And the way that we calculate that is if we have the right to sell shares at 35, but it's costing us $2.25 for that right, in effect, we're really selling that stock at $32.75, the difference between the strike of the put and the premium that we paid. So from $32.75 downward, that's where we begin to make money. And graphically, this is what it looks like. You can see $32.75 is our break-even point. As the stock drops below that, we make money. As the stock rises above that, we lose money up until our maximum loss of 2.25. Now, for those of you that are looking for additional education, you can certainly visit our optionseducation.org website for further resources, including archived webinars, as well as podcasts and other related videos. And certainly make use of our investor services team at options@theocc.com. Now, that being said, Alex, we've got a few minutes left. Any questions for us?
Thanks, Mark and Joe. We do, in fact, have a few questions today, but I would like to remind our listeners that if you have further questions about the concepts we discussed today or the tools on the OIC website, or if we weren't able to get to your questions that you submitted, you can contact our investor services team at options@theocc.com. That's options with an S at theocc.com. They're ready to help answer any questions about option strategies or positions. Now, turning to the questions, here's one. You briefly mentioned index options. I'm looking at trading the SPX, but not sure how it differs from equity options.
So the SPX, the S&P 500, that is an index. Now, the way it differs from an equity is a couple things. First of all, if you have an equity option or an equity stock such as XYZ, that represents the right to buy or sell 100 shares of XYZ. Now, when it comes to the S&P index, which is a collection or a basket of stocks, 500 different stocks, you're not going to take a portion, a partial delivery or a fractional delivery of 500 different stocks. What you're going to do is that S&P, it's what we call a cash-settled index. Because it's not going to be fractional shares for 500 different stocks, they simply put that basket into a cash-settled index. So rather than taking delivery or, rather than being responsible to take delivery or sell shares of stock, you're simply going to have that option settle in terms of cash, and it's going to settle for its intrinsic value. So the difference between equities and the S&P, for example, first and foremost, we've got physical style delivery in the term of equities and ETFs, cash style delivery or settlement in the case of the S&P. Another difference is the S&P is what we call European style expiry, meaning that the options can only be exercised or assigned at expiration, whereas the equities and ETFs, those options can be exercised or assigned at any time. Joe, what do you think? Those are probably the biggest differences between the two?
I agree, Mark. Well said. I'd say let's take another question if we have time.
Does the OCC offer a dummy account that we can practice with?
Not at this time. We are in the process of adding that to our website, and we hope to have that capacity sometime in the next, I think, 3 to 6 months. But at this time, we do not.
Yeah, we did have a virtual trading system that really was fantastic. Unfortunately, the third-party vendor that provided that to the OIC, as well as many other trading platforms out there, discontinued their service of the product. So, as Joe had mentioned, we are aggressively pursuing other avenues and certainly hope to have something in the very near future.
Great. Thank you, Mark and Joe. If I sell an option, do I have to accept assignment?
I'll take that, Mark.
Good question.
Yes, you do. We mentioned at one point towards the end the whole idea of control. Buyers, pay for rights and have control. Sellers collect cash but take on obligations. And that obligation, depending if you're selling the call, you have to deliver the short stock. If you are taking on the obligation of a short put, you have to buy the stock. So you have no choice. You do have to basically deliver on your obligation. Anything to add, Mark?
Yeah, just real quick, my partner over here at the OIC, Bill Ryan, one thing that he says often is the only way to avoid assignment is not to have an assignable position. As silly as it sounds, he's absolutely right. We talked about how over 70% of options are actually closed out in the market. So if you don't want to get assigned on that short call or that short put, typically there's nothing preventing you from buying back that option in the market to close, and therefore you no longer have an assignable position. However, at the end of the day, if you do have an assignable position, if you do have an open short contract at the end of the day, there's nothing you can do to prevent assignment should it happen. If you don't want to get assigned, don't have an assignable position.
Mark, let me add to that, and then we probably will wrap up. But it should not be a surprise when you get assigned. I mean, every once in a while, but very, very rarely, a contract gets assigned that shouldn't be. Typically, contracts that get assigned, have two qualities. there's no time premium left in the contract. Because if you have intrinsic value and time premium and somebody exercises that contract, you as the seller will collect that time premium automatically. So the owner of that contract would collect more money by selling the contract in the marketplace, collecting the intrinsic value and the time value without, giving up that time value. So it's very unusual to be assigned when you have time premium left in your option, or, and this gets into the dividend aspect, if the premium in your contract is less than the value in an announced dividend, then you shouldn't be assigned. So the premium in the contract has to be less than the announced dividend for you to accept assignment. Aside from those two examples, it's very rare that it happens, but it's rare. So the vast majority of the time, sellers of options should have a very good sense for when they're going to be assigned.
Yeah, no, excellent point. It's very rare. Well, I don't want to say very, but it's, as you had mentioned, it's unusual for an option to get exercised early because they are giving up that time value. So, as a short contract writer, whether it's a call or put, you're 100% dead on that. You should be expecting assignment. It should rarely come as a surprise to you if it does happen. And Alex, that's all I have. Just real quick, I just want to thank everybody for attending. Thanks for joining us. And Joe, certainly thanks for having me as a part of it. I certainly appreciate it.
Hey, Mark, it was great. Thank you. And Alex, thanks. Mark and I know we'd love to take a heck of a lot more questions, but, folks got things to do. So I hope we'll get feedback on the new time. Thanks.
Thanks, Joe and Mark. And ladies and gentlemen, thank you for your time today. While we weren't able to get to all of your questions, we have our Investor Services desk ready to help. Feel free to reach out to them at options@theocc.com. Many of you asked about further education. Please visit optionseducation.org, the OIC's website, and see the Getting Started section for further reading. And if you would like to learn more, we encourage you to check out OIC's MyPath assessment to further test your options knowledge. And of course, you can find all of this on our website, optionseducation.org. Thank you for attending, and we hope to see you next week.